Hello, everybody. Welcome to another episode of Simply Bitcoin IRL. I'm streaming live from backstage at Unconfiscatable in Las Vegas, Nevada. Got this set up in the nook of time for this interview, so I'm really looking forward to it. Before I bring up our special guest for today, I do want to give a shout out to the Bitcoin company that makes this show possible, Swan Bitcoin. It's the best place to build your Bitcoin stack. It's being built by Bitcoiners. It's for Bitcoiners. If you haven't already done so, check out swanbitcoin.com today. All right, so let's bring up our very, very special guests. They don't need introductions, but I had the honor to introduce them both at Pacific Bitcoin, and that was really great. And I snuck in a little joke in there, and I said that Lyn Alden is a legendary memer. And what I heard from the crowd is that there was a little chuckle. So I was very, very happy I got to make Lyn laugh. Guys, thank you so much for joining us today.
Happy to be here.
She is.
Lyn's amazing. Lyn's amazing, but she's very like low key about it. Like it's
very low key.
Drops it when it's necessary. So guys, I'm so happy that you guys joined the show today because there's been ridiculous price action over the last couple of days to the point where I'm just like, could you stop going up so high? I'm still trying to stack Bitcoin. So Lyn, what's your take on all this? This is a pretty unprecedented run up.
Yeah, I mean, Bitcoin tends to have these moments where it goes up sharper than anybody thinks, and it goes down sharper than anybody thinks. And so when you have such an inflexible supply, when you have such tightly held supply, when a lot of it's not even on exchanges, even a lot of the coins on exchanges are from people that are not even actively trading. They just leave some of their coins there. And so the amount that's pretty liquid is actually not that big. And so when a significant amount of capital wants to come in, that can move the price very quickly. And I track a couple things. I mean, obviously the ETF news is probably being constructive towards it. The upcoming halving. But another thing I track is that Bitcoin price correlates very heavily with global liquidity. There's different ways to measure global liquidity. I like to use simply global broad money supply (M2) in dollar denominated terms. And so it's basically it either goes up because credit and money printing are happening, or because the dollar is weakening compared to other major currencies. And there's historically when that's going up, usually Bitcoin's doing pretty well. When that's going down, usually Bitcoin's struggling for a period of time. And so all these factors together have been pretty constructive for Bitcoin. And it's just been a long bear market. A lot of the coins have rotated towards very strong hands, and so it only takes a small amount of new demand to move the price pretty disproportionately.
Gotcha. So, Preston, what's your take on, these last couple of days have been literally, I think this was I saw a tweet a couple days ago where this is the first time since 2017 that we've seen 8 consecutive weeks of green candles. That's a very long time. That didn't happen last cycle. So, Preston, what's your take?
Yeah, I think something that people need to really kind of appreciate is as we go into yet another cycle, people that were here in the first and second cycle who have a significant number of the coins, their conviction in this upcoming cycle isn't just stronger or like twice as strong. It might be 100 times stronger. And that conviction is something that for people that are maybe watching from the outside, they cannot even comprehend why a person has that much conviction and why they're watching the price move, call it 5,000 or whatever. I mean, it was down at 26, so it's even more than that. People with a lot of conviction are looking at this and they're saying, okay, well, I guess it's just getting started. We're in another cycle. This thing could go to 100, 500,000, and it's just like, okay, that's what it does. And my basis is in the hundreds or $5 per coin or whatever. And those are the people who are squatting on a lot of coins. And so they're, to Lyn's point, if you're coming into this for the first time and you're trying to understand why the price moves like this, it moves like this because it's actually scarce. Nobody can manipulate it. And the people who hold a lion's share of the coins, they're not ever selling them. Michael Saylor had a really interesting poll that he posted on Twitter today, and he said, "How high will BTC need to rise before you would consider selling a small portion of your Bitcoin?" and he had different prices. He had 100,000, 250,000, 500,000, and a million to never being the fourth category. And 29% of the people that responded to the poll said that they would sell some of their Bitcoin at 100,000. And so if you're an outsider or you're new to this and you're looking at that and you're saying, all right, so that's going to induce some variance or volatility in the price, like maybe once we get to 100,000, it may, and it might do it for the speculators there for a little bit. But what I would challenge people to really kind of think maybe at a second derivative of that is, if you had to take, if you had the market weight those percentages with how many Bitcoin do those people hold, I would tell you that the people who are voting for 100,000 that they'll sell some of their position are people who hold minuscule position sizes. And the people who have really large position size as far as the outstanding inventory are the ones that are saying a million or never. And so what do you think is going to drive the price? The price is going to be driven by these deeply convicted, I'm not selling these coins until I can, buy some equity at like a PE of 5 and they're denominating Bitcoin on their balance sheet type people, because they know what they own. So long-winded answer, but to maybe just a little bit different angle than what Lyn said.
No, and 100%, and I appreciate that answer, Preston, because like the eight consecutive weeks of green candles, this is the first time really that the Bitcoin supply, 70% of the Bitcoin supply is inactive. It's just people are just not willing to part with their Bitcoin, and that's a record high. That's never really happened before either. So these are some crazy times. Anyways, I do have a video to play for you guys, and it's in relation to something that Lyn, you covered this in great detail, and Preston, you wrote an amazing article called "Bitcoin is Anti-Totalitarianism," and you wrote it for Bitcoin Magazine, and it was regarding basically the way that I see it. Politicians using the legacy corporate media in order to attack Bitcoin. And I think there was an escalation today. Jamie Dimon, who was being interviewed by Elizabeth Warren, I might add, he had some things to say about the industry. So I'll play you guys a clip.
I've always been deeply opposed to crypto, Bitcoin, et cetera. You pointed out the only true use case for it is criminals, drug traffickers, anti-money laundering, tax avoidance, and that is a use case because it is somewhat anonymous, not fully, and because you can move money instantaneously, and because it doesn't go through, as you mentioned, all these systems have built up over many years, know your customer, sanctions, OFAC, they can get bypass all of that. If I was the government, I'd close it down.
Okay.
So, saying the quiet part out loud, Elizabeth Warren, and I'm sure you ran into this, Preston. Elizabeth Warren is saying, "Hey, let's." Basically, she was trying to make the connection that self-custody is somehow a crime. So I want to get Lyn's take on this, and then we'll move on to Preston. Lyn, does this surprise you at all?
No, and I tweeted about this earlier. It's really funny because basically the timeline today was hilarious. So on one hand, Alex Gladstein from the Human Rights Foundation is in Kenya, and people are doing a great event there, talking about how there's like a Bitcoin movement there, as there is in many countries. I mean, there's a Bitcoin Indonesia conference, right? They just had the Bitcoin Africa Bitcoin conference in Ghana. This group's now in Kenya. And it's this beautiful, colorful image of people talking about how Bitcoin gives them hope and allows them to kind of get out of this like trap that they're in terms of like constant dilution. Africa has something like 40 different currencies. So imagine all the frictions of global trade. If you're trying to earn money and save money, you're just constantly getting diluted in many cases. A lot of those countries can just freeze your bank account with no rule of law. That kind of thing happens all the time. And this is like a very proactive movement. And then on the other hand, you have Jamie Dimon coming in there, and he's sitting there talking about how this is like just money laundering, and like the God forbid that people can just move money instantly and semi-anonymously. And it's like even the picture itself is gray and stuffy and older, and it's just he could not be doing better marketing for Bitcoin than he's doing right now, in my opinion. But yeah, it does show that there are there are people out there that are powerful that would attack it. I mean, this picture is literally cantillionaires 101.
100%. Cantillionaire is trying to retain that privilege of being able to create money for free that everyone else has to work for, control the money flows. Preston, your article was so powerful. I wanted to read, the one of the last passages of it, and I want to get your thoughts on it. You ended the article with, "The challenge is formidable, but the stakes are too high to remain passive. The United States has a choice. Adapt and embrace the decentralized future of money, securing our liberties and financial leadership, or risk being left behind. Tethered to outdated systems and eroding freedoms, the power of informed, engaged, and proactive citizens is our greatest asset in this pivotal role. Together, we can shape a future that upholds the principles of freedom, innovation, and financial sovereignty." And then you added a quote by Benjamin Franklin that says, "Those who give up essential liberty to purchase a little temporary safety deserve neither liberty nor safety." So, Preston, what inspired you to write this article? And I'm sure you're seeing the same things that I'm seeing. I'm sure you're seeing the same things that Lyn is seeing. So, what's your take?
Frustration is what caused me to write this. I would say I have a sunk cost bias here in the U.S. because of my military service. And I have loved ones. I have family that live in the United States, and I really don't want to have to vote with my feet and go somewhere else. So I'm trying to do everything I can to make sure that it's successful here in the United States, because like I also wrote in that article, Bitcoin is going to be successful whether the United States figures it out, whether whatever country in Europe figures it out. It does not matter whether your country figures it out or not. Bitcoin will be successful. And so for me, it's like, well, I'm gonna at least try to do everything and anything I can to help policymakers or people get this right, as right as they can, and not be a place that's actually pushing innovation into other domains. So there's really, in my opinion, there's two ways to kind of approach this. There's the very professional and constructive way to approach it, which Lyn is probably the best in the business at that. And I try to act that way from time to time. The article that you're kind of quoting there is one. And then today I published another one that is way more in depth, particularly pointed at the FinCEN proposal. It's all in my Twitter feed if people want to check it out. And what it is it's a turnkey way for people to open the document, go through. I cover in a lot of like excruciating detail where the proposal really comes off the rails, and effectively is just a giant violation of your rights, whether we're talking about the violation of the Fourth Amendment right for unreasonable searches and seizures. And I get into all the case law that kind of supports that. The freedom of speech, which I get into all the case law that supports that argument. Infringements of your rights to financial privacy. There you go. This is the article here. Undermining due process rights is another one. The erosion of your rights to be secure in personal information is another one. Non-discriminatory violations. It goes on and on. I could go on all day on like all the rights, but it's backed up by as much case law as I could conduct research on and find. I have it all laid out. I have links. Most importantly, I have links in it for people to click on. It takes you straight to the register for that particular FinCEN proposal. So people can take my work, they can copy and paste it into the register and comment, because here's the logic on this. People look at this and say, well, this is a losing battle. They're going to pass this anyway. And they're correct. They are going to pass this, and they're going to have massive breaches of your rights. But on the other side, after they pass it, the people that actually will bring the balance back are the businesses that have to battle all of this in a court system. And if those lawyers have a document that's in the register before it was passed that points out all the violations in nitty-gritty detail, that lawyer is going to have a lot easier time saying, look at this spot right here posted 2 months before this was approved that says you were violating all of these rights, and here's all the substantive case law that supports those arguments, and it's going to help those lawyers on the other side to get a lot of this overturned, or to at least assist in that process. So whether it's going to be helpful or not, that's yet to be seen. I tried my hardest, along with Lyn and many others from the Ego Death team that helped edit this with me, and I'm really excited about it. I highly encourage people to look at it. And one other thing on this, feel free to take my comments and pump it into Chat GPT and spin the language into whatever you want it to represent your voice. I would highly encourage people to do that. It's a document for everybody to use, and not just something for us to kind of point at and say, "Oh, this is it. That's the answer." Make it your own and really kind of take action. Because if you don't, well, then you're going to get the government that you deserve. So, I'm sorry. This was a really long answer. I'm sorry, Lyn. The other thing that I wanted to say, so there's two ways to go about this. There's the constructive way, and then there's the meme way, which I guess Lyn is also really good at that as well. So if you go to my Twitter, I don't know if you guys can pull this up quickly, but if you go to my Twitter and you pull up the media tab on my Twitter, you'll see that I have a picture of Jamie Dimon crying. And I think that this is also an important way to, really kind of, fight back. So here's Jamie Dimon on the Hill today. Scroll down just a little bit. There you go. Here's Jamie Dimon. He's on the Hill today, and he's just crying about how this isn't fair, and if he was the government, he would block this, and he would shut it down. Well, you know what, Jamie, go to China and ask them how they shut it down, because they've already shut it down 3 times, and maybe you can take a play out of their playbook. And I think it's important for people to fight back for the corruption that a company like JP Morgan that paid, I don't know what it was, $80 million for the Epstein stuff to not come out. This is the guy that's on the Hill testifying about how corrupt crypto and Bitcoin is. And, he's the best marketing person. Like Lyn said, he's the best marketing person we could have. And here's a good picture, catching him in action.
Yeah, and your words are very powerful, Preston, because as a first generation American, my parents originated from Venezuela, and Venezuela went from one of the wealthiest countries in South America to one of the poorest. You can even call it a failed state, and it went down the collectivist path, to put it nicely. And that's something that, a lot of people they take it for granted in the US. They really do. And, the Fourth Amendment completely trashed, no unreasonable searches and seizures. Patriot Act got completely rid of that, and if we don't stand our ground in terms of, fighting for the First Amendment, things could get bad, and people don't understand how bad things could get. I do want to connect this with Lyn's book, and it's absolutely incredible. So I do want to talk about Broken Money, and I want to connect it to what Preston was just talking about. So in Broken Money and Monetary Systems and Individual Freedom, Financial Freedom, your analysis, Lyn, in Broken Money suggests that the currency monetary system impacts individual financial liberty and government authority. How do you see the balance between individual financial autonomy and state control evolving, especially in the light of the increasing digitalization of money? And I want to start off with that question, because I think that was the first conversation me and you had one-on-one at Pacific Bitcoin 2022, and we were talking about this specific subject.
Oh, Lyn, you're on mute.
Lyn, I think you're muted.
Sorry about that. So first of all, Preston's article is a masterpiece. People should check it out. And in Broken Money, even though it's a book about money and about monetary history, past, present, and then future, and kind of informing people all about different types of money, there's a whole final part about privacy and about human rights, and that intersection between technology and human rights. And so there's a reasonable question: why is that in a money book? Even a handful of reviews are kind of like, oh, I loved most of it, but why is there this weird section in there? But I think people that follow my work would know why it's in there. That basically you can't completely separate money from ethics, or money from privacy, and money from just all these other topics that are relevant. And so part of the discussion, part of what can in some countries slow Bitcoin down, is basically people begin to view it unethical for one reason or another. They listen to Jamie Dimon or similar types of people and say, okay, that's all for money launderers and things like that. So I think it's important to kind of counter that, and to say, okay, well, wait a second. I mean, why is privacy in and of itself bad? Why is being able to self-custody and then send money quickly bad? Why do we have to go through Jamie Dimon's centralized surveilled, ledger if you want to send money or hold money, right? And so that component I think is really important. And what FinCEN's trying to do here is they're doing their best to try to slow down privacy technologies, make it burdensome for any sort of Bitcoin broker, Bitcoin exchange, to interact with any sort of even non-custodial privacy tools or people that have recently used them. And so it's trying to add friction for people that are trying to be relatively private with their money. And it's not even just privacy from the government; it's privacy from corporations. If I pull my money out of an exchange and I spend it on different merchants, I don't necessarily want that exchange to see all the things I'm spending it on, or you know, it's privacy. It's my money, right? And so um, I think that as this moves forward, I think that's privacy is going to be one of the biggest battles, right? It's already the case that that's one of the things that people actually go to prison for, right? Operating a mixer, right? Things like that. So, you know, privacy is already kind of the biggest kind of highest stakes battleground, right? So I think a lot of countries are coming around to say, okay, well, you can hold Bitcoin in a ETF, you can hold Bitcoin in a registered, big like honeypot silo that we have surveillance and control over. But what countries don't really like is self-custodial Bitcoin, private Bitcoin, and things like that. Um, and so I think that's going to be an ongoing thing that's not going to be resolved anytime soon, and there's occasional flare-ups. And right now, what we're seeing is a pretty significant attack by FinCEN. And so I think it makes sense to be aware of it, be informed about it, and do your best to push back against it, because it's going to be a long war, in my opinion. And I mean that in the hopefully in the peaceful sense. Basically, that one side can be aggressive, and the other side, we have memes, right? We can win the war through narrative. We can win the war, and especially in countries like the United States that still have a pretty good rule of law, right? I mean, we saw, for example, the SEC in their attempts to block Bitcoin ETFs got absolutely smacked down by an appeals court. Their arguments were said to be capricious and arbitrary, um, and that kind of thing happens all the time. I mean, back in the 1990s, when Phil Zimmerman, released open source encryption, the United States government went after him. So he published it in a book and said, "Well, it's the First Amendment now. So kind of come at me, bros." And they lost. That David beat Goliath. People like even Adam Back and others would put like encryption on T-shirts and say this is like a dangerous T-shirt. It's like weapons grade munitions if you export it, right? And it shows the logical absurdity of a certain situation. And one of the modern day formats of that is memes, right? So it's like you can picture like like a character from Inglorious Bastards, like that Nazi guy, and you can write like um, are you hiding like 12 words, right? You're hiding 12 words, aren't you? Like you can do various kind of memes to show that beyond a certain point, some of these rules get utterly silly. It's basically about saying that you're using information, you're using code and numbers and words in a way that we don't approve of, is ultimately what this comes down to. And so in the United States, rather through the humor route, the satire route, the court jester route, where you're basically informing people or pushing back on things in funny ways and therefore helping change their minds. Or two, you're taking the more rigorous approach and saying, okay, well, here's all this case law, here's all this precedent, here's the Constitution, here's this other set of laws that makes this clear overreach, and that people do have these rights. But I do think this is going to be kind of a multi-front, long-term issue.
I do agree with that, and just because of what's at stake, right? Governments get a tremendous amount of power from the current system. So it's kind of common sense that they would try to maintain that. So I do want to pivot the conversation a little bit in regards to macro, in regards to what's going on, because I think a lot of people were expecting this recession. It's been coming, this so-called recession. But if you take a look at the key U.S. economic indicators like GDP, the GDP is strong growth, inflation is sharply down, trending right, full employment, and a significant number of new jobs added every month. Deeper metrics, liquidity levels, consumer spending, consumer sentiment, consumer credit, durable goods. There seems to be no major cracks in the economy at the moment. We seem to be headed into a lower interest rates and soft landing and Goldilocks scenario. Do you agree with this? Because I don't really see the impending doom on the horizon. And I'll add like another element to this question as a Bitcoiner. Like, isn't this the case for central banking if they pulled off this so-called soft landing? Preston, it seems like I triggered you with that.
No, I love the question, and it's a near impossible question to answer. And the reason that I'm giving you a non-answer is because it all comes down to the speed and the magnitude of how they react to this as we continue to march forward. I can tell you from looking at the inflation numbers and how you're starting to see upticks in unemployment on a chart, that the economy is struggling. Let me turn that off. Oh my gosh, Lyn's probably laughing her tail off. I can't even tell you how many discussions I've had with Lyn where that keeps popping up. Anyway, so I got distracted. So the thing that I think that makes it really hard is they could step in and they could say, hey, we're going to add 5 trillion units here, and we're going to flood the market in this way and that way. And so similar to like what we saw with Silicon Valley Bank, and you're just not going to have this big, giant cascading impairment kind of hit the market that I think people are familiar with when they think of like 2008 crisis or what played out very briefly for COVID. And I think COVID's the perfect example to show you and everybody listening to this what they can actually do by manipulating the monetary units in the system. During COVID, we had everybody at home. Nobody was at work. We had oil at negative prices. We had people not spending money on the roads. They were holed up at their house. But yet, if you looked at what happened in the financial markets, in equities in particular, they ripped like crazy and quickly. And it's because of the sheer amount of stimulus that was dropped into the market through that. So when we look at 2024 coming along, I have no idea how they're going to respond. I think anybody telling you that they do know how they're going to respond with respect to the speed and the magnitude is just lying to themselves as to like what it is that they think they know. So I can tell you that I will say this, and I'm curious if Lyn would agree or not. Like, there are massive deflationary pressures building in the global economy right now. Massive. Like once the reverse repo dries up, and like if they truly didn't do anything and they allowed cascading impairment to occur, like this thing could get really nasty. I don't think that they're going to do that, but I don't know the magnitude and the pace at which they're going to address it.
So, and before I pass it on to Lyn, you did mention the reverse repo. So it looks like the government took care of the cash crunch, but the reverse repo market has gone from levels of 2 trillion to a low of 768 billion earlier this week. Just to add to your point, Preston, pass it on to you, Lyn. Is this potentially a worrying sign in the banking system?
Is that to Preston or is that to me?
That's to you, Lyn.
Oh, so basically the reverse repo facility, the way to think of that is that basically represents excess demand for T-bills. And so what the Fed does not want is for there be so much demand for T-bills that it pushes T-bill yields below the lower end of their target short-term interest rates. And so they have this release valve where money can instead go into a reverse repo facility and get yields that are similar to T-bills. They hold it at that level to make sure that basically there's no reason for T-bills to go below the reverse repo facility rate by any significant degree. And that's part of their kind of tightening process. And when the Treasury issues a ton of T-bills, that money can come out of reverse repo and into T-bills. So reverse repo is one of those things where in a healthy market environment, there really shouldn't even be a reverse repo facility. Right now, it's just kind of this excess pocket of liquidity that was built up during the stimulus, and now it's kind of coming back out, and so it's kind of counteracting the Fed QT. The reason it's relevant is because after it runs out, um, if the Fed continues doing quantitative tightening, that'll be start to come out of bank reserves. It'll start to kind of kind of reduce liquidity in the core banking system, and therefore increase the odds of some sort of liquidity accident. Which if it shows up in the Treasury market, you'd probably have the Fed come in and stop QT. A similar thing happened back in 2019 with the repo rate spike. It wasn't some gigantic event for normal people. I mean, basically, it's one of those like quiet crises that most people don't know of. But if anyone who was like following macro or banking at the time was like watching this with interest, because you had kind of an interbank overnight lending rate just completely blow out, and the Federal Reserve, in addition to addressing that market, had to come in and start buying treasuries again. Because that was kind of the core problem. There was a treasury oversupply problem. And going back to the prior point of, soft landing versus hard landing, I've been using the term emerging market landing, because when you look at like recessions in emerging markets, they look pretty different than we see in developed countries. You know, um, you have an environment where you have kind of recession-like conditions, but asset prices in local currency terms are still doing okay, because the local currency is pretty running, often very large deficits, is often inflationary. Um, and so you get these weird dichotomies where it's like a hot recession, right? It's like an inflationary recession, a stagflationary recession. And so asset prices and things like that are not doing great in, dollar terms or gold terms, or things like that, but they're doing okay in local currency terms because local currency is having a problem too. And those types of recessions only come up rarely in developed countries. We had it back in the 70s. We arguably have it right now, and we had it back in like the 40s. And those are kind of the instances where this pops up. We also see there's a very big divergence between fiscal and monetary. So monetary, like Federal Reserve, Jerome Powell, they're trying to be relatively tight. They're trying to hold rates at a high level. They're trying to reduce their balance sheet. It's largely coming out of reverse repo. On the other hand, the government, Congress, president, and all these groups, they're running very, very large fiscal deficits. And it's not even just now, it's accumulated from decades past. So a lot of it is just interest expense is completely blowing out, ironically, because the Federal Reserve is trying to tighten. And fiscal deficits, all else being equal, are stimulatory and inflationary. And so whether or not we're going towards recession, or whether or not, how the economy is going to look like this year, a lot of it is basically what industry or what sector you're in, because some sectors are already in recession. If you're in commercial real estate, you're in a recession pretty much. If you're relying on volumes of residential home sales, you're in a recession. Um, if you're a small business that needs access to bank loans, those update pretty quickly. So higher interest rates, like lower interest rates from loans a few years ago, are getting rolled into like higher interest rates today. They don't have very long durations, so a lot of them are pressured. On the other hand, if you're not in an interest rate sensitive industry, right? If you're in travel, if you're in restaurants, if you're in profitable tech companies, you might look around and be like, what recession? This kind of past couple weeks had record numbers for flights in the United States, or flight passengers in the United States. And so, if for example, if you're a 50-year-old upper middle class investor, you might have a fixed rate mortgage on your home. You might have a large kind of amount of T-bills and money markets. Let's say you're 50 or 60, you're kind of gearing towards a lower volatility type of portfolio at that point. As the Federal Reserve increases interest rates, your interest income increases. You're getting more money from your money market accounts. You're getting more money from your T-bills, and you can actually spend more into the economy. That you're actually being stimulated by the Fed's tightening policy, because your liabilities, your house and your fixed rate mortgage, are not changing at all. The same thing's true for investment grade corporations. If you're Google right now, you have very little debt, you have tons of cash, and now your cash is yielding higher rates. So you're actually it's actually, all else being equal, improving your bottom line, which is mildly stimulatory. And so we have this kind of weird dichotomy, which is that if you're primarily reliant on short-term financing or a lot of financing, you're probably in trouble. You're already probably in a recession, or at least your industry is. And if you're not, and if you're on the right side of deficits, if you're the military-industrial complex, if you're kind of in your own, if you're on the right side of all this interest expense, then you're doing okay. And so I think that's why the economy is kind of feeling very odd to people, because it's we have a larger gap than normal between fiscal policy and monetary policy, and so that results in kind of very bifurcated economy and very bifurcated markets.
Yeah, it's interesting times to say the least, and specifically from speaking from someone millennial generation and the Gen Z. Usually, the younger generations are in the lower and middle classes. They haven't had the time to accumulate wealth. You can't afford anything. Like housing is just complete. Like forget about it. You're not going to own anything. Thank God. I got into Bitcoin in 2016, 2017, and provided some type of hope. But it's what are you going to do? Like, what are people going to do? And I'm sure that you guys saw this clip on Twitter because it went viral. But it was Breedlove on Peter McCormack, and he was talking about essentially the amount of money that they printed over the last couple of years was the equivalent of like stealing 2 million human lives of productivity, and just the absolute time theft. So just passing it on to you, Preston, if you wanted to add to Lyn's point or to my point.
Yeah, no, Lyn's talking about something that I think is really important, and it's really kind of the dislocation of what, like where you sit is what you're seeing. And my response to your original question was much more broad and very generic as to like everybody's saying there's going to be a recession, and my response was that it's going to be situational, dependent on how fast they add it back in, the monetary units back in. But Lyn kind of enhances that in a much better way, because what she's really saying is even if they add it back in, that those monetary units are going to immediately nest themselves into certain industries that are going to benefit from that, and then most industries aren't going to benefit from it, and there's going to be a huge recession in those areas. But what normally gets all of the media attention, or what we talk about on Twitter and in between each other, is really kind of the broad index, or like the S&P 500 or the Dow, when we're comparing financial markets. And so those are going to rip, because those are dominated by just a couple companies via market cap. And so that also adds to the confusion, is you're watching the financial news and they're like, the markets are up. But for people that are maybe not part of Apple or Google or whatever, for them, they're living a very painful life and experience through yet another market cycle, and they're adding all this stimulus into it, and they just can't figure out like what is happening. Well, her much more nuanced take that goes in there and really kind of describes in a whole lot of detail like what's going on in each one of these sectors is, I think, super important for people to consider when thinking about like why does it look like this, and why is it going to continue to look like this and get amplified as we continue on the timeline.
Gotcha. So as we're heading into 2024, right? And you guys covered the recession topic. In Bitcoin world, the future seems very, very bright. And if there is a potential recession, Preston, how do you think Bitcoin would perform in that environment?
It really depends on how ferocious the cascading impairment is. So going back to 2020's COVID, it was really quick, because I think the whole world kind of came to this realization like, oh my God, this pandemic is literally shutting down the planet. And so all of this credit, all of these assets that everybody thought they knew like where they were at, what kind of cash flows they were going to produce, was flipped on its head almost overnight. And you saw cascading impairment across the board in this credit fractional reserve system that we currently live in. And so because of that speed and the magnitude of that event, we saw Bitcoin go from, I don't know where it was at, probably 10,000, 11,000, and it sold off sub 4,000 for like over a 60% decline in days. Do I think that that's going to happen this time around? I don't know. But if we have a lot of impairment, like a lot of magnitude and a lot of speed, it could sell off pretty hard, because you're comparing it to monetary fiat units that are evaporating and becoming extremely scarce in a very short period of time. Basically, the dollar's aggressively getting bid in a scenario like that. But you can rest assured that they have to respond to it. They're not going to just replace the monetary units that went poof in that scenario. They're going to add more, a lot more. And when they do that, you're going to see a swift recovery if that scenario would play out. I don't I don't think that's going to play out, but I have no I would have told you I didn't think COVID could happen, at the start of the new year. So, it's really it's situational dependent, but when you understand how the system functions, you can kind of, I guess, keep a really open mind and a broad array of potential outcomes. But the thing that I think people can really bank on is they're going to print more. It's going to be a lot more. The pace is kind of questionable, and the way Bitcoin reacts to that is dependent on how they kind of respond to a certain extent, not completely, but to a certain extent.
And thank you, Preston. The same question for you, Lyn. How do you believe Bitcoin will behave in a recessionary environment?
So I think it'll be more about liquidity than the recession. There's different types of recessions. The some of the recent recessions we've had, so the 2020 kind of lockdown crash, as well as the 2008 banking implosion. Those types of recessions had this big illiquid cascade, right? That basically liquidity dried up. The dollar got very strong, and pretty much everything correlates to one in those scenarios because there's all these forced sellers. And one way to think about it, especially on the global scale, is that if there's a sharp slowdown in economic activity, the debt starts to become a problem. So all these entities have debt in the U.S., outside of the U.S. Outside of the U.S., it's often denominated in dollars, even though it's not even owed to the U.S. Like some country in Latin America will owe dollars to China, or some country in Africa will owe dollars to France, for example. Or some entity in Indonesia will owe dollars to an entity in Japan. And when this happens, cash flows dry up, but those debts and those interest payments are still due. And so there becomes a dollar shortage. There becomes like a currency shortage, ironically, because they're always printing more of it, but you can still have brief shortages. And so what happens is basically a lot of entities become forced sellers of any asset they have. And, before Bitcoin was around, people would look at gold during recessions, and often in the very early stage, gold would sell off. But then once liquidity measures came in, gold would recover more quickly than stocks, and it ended up being a really kind of good play through that cycle. With Bitcoin, I think generally speaking, if you have specifically a liquidity crisis, that's when you can get kind of a sharp sell-off in Bitcoin. And I think it'd be brief because I think that liquidity issue would be resolved. But not every recession has a big liquidity crunch associated with it, especially when you look back further, and especially when you look at certain emerging market recessions. You just don't really, and I think some of the recessions that we're going to see in developed countries have emerging market characteristics just because of how large some of the fiscal deficits are. And so I wouldn't necessarily count on Bitcoin going down sharply. Now, it could go up to 60,000 and then come back down to 40,000 and then go back up again, right? So there are people that are not buying Bitcoin. They weren't buying Bitcoin at 20, 30,000 because they're worried about a correction next year. And it's like, well, where does that correction come from? Does it come down from a level that's twice as high as now and still higher than now? Does it start 50% higher than now and come back down to where it is now? Would we even get a liquidity crunch? And so I think that the question is less about recession itself. Like it's not really directly tied to employment in the U.S. It's not really directly tied to, just kind of various recessionary measures. It's really kind of tied to that liquidity, which is things like the dollar index. Whether markets are functioning with liquid fashion. Are there forced sellers? Things like that. So I would incline towards, yeah, you probably would have a period of liquidity shock. Like if you run out of the reverse repo facility and we have a significant liquidity shock, Bitcoin might have a bad couple weeks, but I'd be a buyer of those dips. Interestingly, we saw back in the March 2023 kind of banking mini crisis, Bitcoin did really well right away, and so did assets. Basically, assets all basically immediately said, "Oh, the Fed's going to have to add liquidity here," And so Bitcoin and other assets went up in what otherwise could have been a liquidity problem just because they understood how fast some of this response time is. And so I generally err on not trying to be too kind of. I think there's going to be there's periods where people are going to get too smart with it, and therefore they're not going to do well, right? The people that were waiting to buy Bitcoin at 12,000, for example, are probably never going to see 12,000. Would be my guess. Um, and people that are always kind of waiting for the next correction. I think instead the right answer is either lump sum and then keep dollar cost averaging, or just maintain a position size so that if the asset goes down 30% or 50% in purchasing power, you're not affected. Bitcoin really should be capital that you don't need to access for 5+ years, so that you can let the thesis play out. And if you position it like that, and your position size is not so big that you're having sleepless nights because the asset's having a correction, then I think that's how I play it.
And just to kind of add to that, Lyn, I think a lot of the psychology behind the people wanting to buy the dip, so to speak, I think it comes from the unit bias, and also which is the theory of this cycle. And American Hodl did a great job tweeting about this, which is the theory of diminishing returns. What's your take on that, Lyn? Oh, I saw Preston laugh. Maybe I should pass it on to Preston first.
Yeah, go to Preston first.
Preston?
I am I support this stock to FOMO chart. And I say that kind of jokingly, and because people who look at this and are saying, oh, well, once it gets to 1 million, I'm going to sell and I'm going to take some massive, returns. They don't, what they're really saying is they have no clue what's actually playing out here. Because if this goes to 1 million, it's going to 10 million, it's going to 100 million, it's going to look like a Zimbabwe note of 100 trillion units. And that's what I think. If you think it's just going to go up to 500,000 and then it's going to kind of stop there, and that's kind of like where it ends, and like that's the end of Bitcoin. It's now stabilized at 500,000. You really do not understand like what's playing out here. And I think the higher that you go like that, the more aggressive the bid is actually going to get, and kind of get away from legacy policymakers and people controlling currencies, fiat currencies as we know them. Now, when does that happen? I don't know when that happens. I don't know if it's this cycle, next cycle, or whatever. I don't know. But people that are suggesting that Bitcoin is going to have smaller and smaller returns into the future, I think are getting duped a little bit as to like what kind of plays out in the middle of that S curve. I think that's what's happening with those kind of ideas and comments.
You are extremely bullish, Preston. I like that answer. Makes me want to just go ahead.
I don't see it as being bullish. I see it as being, I'd like to think it's just very logical. Like for us to go from something that was worth a couple pennies to $1 million for an imaginary Mario coin like thing that's just a ledger entry on a global database, for somebody that would hear that 5-10 years ago, they would have literally laughed you out of the room and said, there's no way that could happen. And then the question you should have asked that person is, okay, well, at what price would you stop laughing and take it very serious? Which was the actual question that was proposed to Andrew Sorkin this week on CNBC. And as you noticed, he refused to answer the question. And him not answering the question is telling you what he actually believes, which is, I don't want to be wrong, and I don't want to say 100,000 or 500,000, because in the back of his subconscious mind, it's going there. That's why he's not going to answer that question. And so, once you start getting to those levels, what's really being communicated through the money is all trust is breaking down in the legacy monetary units. Okay, make no mistake about it. That trust is eroding. That's why somebody's willing to squat on an imaginary, entry in $1 million a coin price, is because they actually have way more trust in that system than the legacy system. And if you think that that trust is going to kind of like stop or plateau at that point, I don't know what to tell you. I'm sorry, you don't understand it, like point blank.
Yeah. What about you, Lyn? What's your take on it? Preston's put a lot of thought into this. I could tell. Lyn, what's your take on this? Are you a believer of the diminishing returns, or are you a non-believer?
So I think it depends on details. Last cycle, before the cycle played out, when I was kind of recommending it to people in 2020, I assumed a diminishing cycle. And because the numbers in that kind of intermediate term period, I think would be pretty big for that one cycle. And it actually underperformed even my diminishing. Like I thought we'd hit 100K, for example. Actually, my initial estimate when it was like under 10K was like 30 to 50K at least. It was like a really conservative one. And then we hit that. I was like, well, I think it's going over 100. And we never really hit that second target. We later found out that there was a lot of rehypothecation and, people naked shorting Bitcoin like FTX. And, there's a lot of things that went into that. We also had like the tightest Federal Reserve policy, the most rapid tightening in a very long time, as they try to fight back against the inflation that they partially caused along with the fiscal authority. Um, and so I did expect diminishing returns last cycle. This cycle, I'm much less confident that there's going to be diminishing returns. I think there's a good case to be made that this cycle or the next cycle has a surprising breakout where there's not diminishing returns. And so everybody kind of has it in their mind of what's going to play out, and I think it's going to surprise one way or another. Last time it surprised to the downside. I think this time could easily surprise to the upside, and the people that think they're bullish at like 100K or 200K could get completely shocked by the numbers it hits. But then again, maybe not. Maybe if it goes to 150 and then maybe it corrects down to half that and then goes up the next cycle. There's so many variables that go into these things that I try not to give any sort of specific price in any sort of 2-year time frame. The statement that I generally have pretty high conviction on is that usually Bitcoin does well in global liquidity positive environments, and usually it struggles in lower liquidity environments. That's one of the biggest factors that goes into it. But I never really associate a specific magnitude with those kind of more directional observations. And you mentioned unit bias. I do think that's one of the things that holds people back. They see $40,000 a coin, and some people don't even know it's divisible. That's its own thing. But even people that know it's divisible, it seems expensive. So what I would point people to is market cap, right? Market cap, I think, is a more sensible way of looking at it, which is that should this asset be bigger or smaller than one company like Nvidia, right? Should it be bigger or smaller than gold? Should it be bigger or smaller than Apple? Should it be bigger? What percentage of global assets or global purchasing power should this be? Right. I think that's a better way to think about it because it's a divisible asset. There's 2.1 quadrillion satoshis. Um, and so the unit can be whatever you want it to be pretty much. And it's really about just the overall purchasing power of the network and your share of the network. Um, and so I think that's kind of a way to approach it. And for people trying to trade it, it's like, people are waiting for these specific price targets. Either they want to exit at a certain price level or they want to get in at a certain price level. And I just don't think that's the best way to think about it. I think the way that the time it makes sense to either take chips off the table or add to your position is more so about risk management, volatility management, making sure that your portfolio is not kind of keeping you up at night. So for example, if Bitcoin goes up tremendously and the daily moves begin to just overwhelm the rest of your assets and you're always thinking about it, yeah, it can make sense to take some off the table and put it back into equities or buy a real estate with it, or whatever if you're holding back on a consumption, that might be the time to do it. On the other hand, if it's in despair and it's got completely crushed, and you have liquidity from income or other sources, maybe that's a time to lean into it. The way I approached it last cycle was I didn't touch my cold storage at all. I do run these model portfolios, for research clients, and that's got this, Bitcoin slice in it with things like GBTC or different brokers have different way to get Bitcoin price exposure. And for that, I would take some chips off the table and then put some chips back in. every 18 months or so, and it's not based on a specific price target. It's more just based on, is this asset going way above the allocation percentage that would I think would scare away people kind of following this portfolio. And then when it dips back down, it's like, okay, now it's cheap, now it's under allocated, I'm going to add back into it. But that's really more about kind of that portfolio management. Whereas cold storage Bitcoin, I'm one of those people that's just there's the price that would get me to sell those coins is not really a price. It's more about what can I buy with those coins.
Yes.
I agree with that Matrix meme of like, like you tell me I can trade it for millions one day, and it's like, no, when you're ready you won't have to, which is basically the implication that I would generally hold it until I either want to, basically it's money, right? So I would hold it until there's something I want more than that money, right? It could be I want to consume something. It could be there's an investment that I finally perceive to be kind of better than Bitcoin, because Bitcoin's already huge now, and it's like, it's closer to its total addressable market, and maybe there's a really cheap investment that I think is going to actually outperform it. I would diversify, relocate into some of those assets, but that's a zip code away from in terms of price from where we are now.
I got one follow up on the unit bias piece. So when BlackRock rolls out their ETF or any of these other ETFs, and I am definitely not encouraging people to own these things, but I think it's going to solve some of that unit bias that is so prevalent. I can't even tell you how many times I've talked to people and they said, "Oh, Bitcoin, yeah, I can't own that. I can't afford a $40,000 imaginary coin." And I'm sure everybody listening to this has had that same comment said to them so many times. So if I was BlackRock or any of these other ETF providers, like when I roll out the product, right now Bitcoin's at $43,600. I would make it $4.36 per share to buy. And that way it kind of tracks the price of Bitcoin at a much lower unit cost in their minds. And if it goes up, any base 10 growth, now it's $43.60 a coin, and then just debase those shares down so that you kind of keep it at a small unit. And I think you would attract a whole lot of people into that product just out of sheer I hate to say this, stupidity, but it is.
Yeah. So, guys, I do want to be respectful of your time. We are getting to the top of the hour, and I do want to leave the conversation with one more question. And the question is, the next 5 years, very turbulent times. We have a crazy election year in the States, to say the least, next year. Of course, the disintermediation of money, the question is, what keeps you up at night? So I'll start first. And what keeps me up at night is, and I had this experience recently with my friends and family, because I am the Uncle Jim of the family, and I realized very, very, very quickly that they've had their Bitcoin in cold storage since 2016. But if anything ever happened to me, forget I don't know if they're going to be able to access it again. So I think that Bitcoin self-custody is not as easy as people think. I think it's not as it just, the incentive isn't there for people to learn it. That's what worries me. That's what keeps me up at night. Hopefully some great entrepreneurs, some great Bitcoiners are able to tackle that problem. So I'm going to pass it on to you, Preston. What keeps you up at night these days?
Nothing. I want to keep Jamie Dimon up at night. I sleep really well. There's things that I'm working on, like the FinCEN response and other things that I'm trying to put out into the community that other people can fork, that they can use themselves. Just because I'm saying that doesn't mean that I think that there aren't things there that I think we should be focusing on and improving. Ocean just came out with their new pool, which I think is really smart. There's a lot of people that are talking about how they're criticizing the fact that the template, the block template that they're currently producing is not intelligent, the way that they're cutting out a lot of the ordinals and inscription things. But what I think people really need to pay attention to is the roadmap, which is, if you're providing a mining rig into that pool and you find a block with your rig, you're going to be able to supply your block template and not have some mining pool unilaterally tell you what block template you're going to use. And that, to me, is a huge innovation and something that really needs to be paid attention to. And huge kudos to Luke Dasher and other people that are working towards that end goal of allowing the rig provider to provide the block template that is actually mined, because that's not how things currently work. I think that that's an area that has recently been resolved, and I would love to see other pool operators kind of implement something similar in the future, and hopefully they're a trendsetter. But don't take my comment as being egotistical. Please take it as I like to be constructive. I like to be constructive in a way where I'm not necessarily broadcasting everything that I think are vulnerabilities. And I think that the people who need to be sleeping really poorly at night is everybody on Wall Street.
100%. And I think they are. I think Christine Lagarde is having my producers going like this in the background. Loved your response, Preston. So Lyn, what about you? What keeps you up at night? Is there something that worries you about the U.S. economy, perhaps about Bitcoin adoption, et cetera, et cetera?
I think the biggest risk for the world is energy security in the multiple years ahead. Not the next 6 months, but just over the next decade, next 15 years. I think navigating this kind of upcoming capex cycle, there's this like lack of, I think, education around where energy comes from. The difference between different energy sources, politicians dictating what energy gets produced rather than engineers, when it's a technical engineering kind of problem. And so I think there's lots of things that can happen, like recessions and problems like that don't really, they're not really doomy. They're just kind of hurdles. Whereas a thing that can be really doomy for people is acute energy shortages. That can be just absolutely death. People can die from things like that, especially in developing countries. But basically, that I think is a key thing for humanity in general to navigate in the next years and decades. For Bitcoin specifically, I think I agree with Preston. It's about being constructive. It's saying, okay, what about the network could use more work? And so I agree with you that custody is something to improve. When we look at overall kind of just levels of decentralization of the network, right? Pure decentralization is a platonic ideal that we always kind of reach for. You can never really achieve 100% decentralization. So it's like, okay, how can you asymptotically approach pure decentralization? What is currently imperfectly decentralized? I do think mining pools could use more decentralization. Stratum v2, things like Ocean. I think that's helpful for that. I think supply chain centralization is not probably talked about enough, which is basically that there's very few foundries in the world that produce leading ASICs, and so that's kind of an attack vector that I think is worth just distributing more than it currently is. There are some companies working on that. But overall, I mean, the UX and the quality of the network is better than it was 5 years ago, and 5 years ago was better than the 5 years before. And I know that because, even though I didn't get into Bitcoin until several years ago, I looked at it back in 2010, 2011. I mean, that's, it's, I kind of hate to say it, but yeah, basically, like, I was never one of those people that was against Bitcoin, but, it's like, I heard about it. I thought it was neat. I was like, oh, maybe I should mine some because I knew someone that was mining it on her computer. And I kind of looked into it. I was like, oh, this seems complicated. I'll get to it next week, and I just didn't do it. And then, a few years after that, I was like, well, let me just buy some because at that point it was, you can't really mine it anymore. But I was like, let me buy some. And so I would look at the exchanges, and they were really sketchy looking. And I was like, I'll spend more time next week to figure out how to buy this and not get scammed. And I just never followed up on it. And so it took a couple cycles to really, to get into it. But that gave me the benefit of kind of firsthand, at least seeing the UX along the way, almost since inception. And the UX is definitely getting better every year, and especially every kind of 3-year, 5-year increment. That the UX is just totally different than it was years ago, and much better. And a point that I made with Preston in our fireside at Pacific Bitcoin was, and this is kind of my last point about unit bias. I want to return to that. Is that for people in Bitcoin, everybody's seen the log chart of Bitcoin price, which is, like, 4 cycles of just higher highs and higher lows. But I think it's important to keep in mind that the vast majority of people have never seen that chart. Years ago, when I first looked at Bitcoin in logarithmic terms, I was like, oh, that that's what it looks like. Because whenever you look at it in linear terms, you always see one or two things. Either it looks like you're in an insane bubble, or it looks like a massive bubble just popped and the thing's dead. Whereas when you put it in log form, you see this more rhythmic, like this heartbeat of Bitcoin, this like accumulation cycle, this leveraging cycle that breaks and then it kind of rebuilds and goes up again. It's a very firm trend. The magnitude varies and things like that, but the cycle, and there's no guarantee that that timing remains exactly as it is. Basically, it looks much less like a bubble or a broken bubble whenever you look at it in those terms. And I think it's important to remember that, everybody in Bitcoin, Twitter, and Nostr, everybody's seen that chart, but 90% of the world has not seen that chart. And so what they see is they don't see the full history of Bitcoin. All they really see is the cycles that they were aware of, right? So for most people, that's not the early cycles. They saw probably the 2017 cycle. They saw the 2020-21 cycle. And so for a lot of people, it's not how many cycles has Bitcoin had, it's how many cycles have they seen, right? Because if they see a high, and then a crash, and then a higher high and a crash, and a higher high and a crash, eventually they're like, well, wait a second, what's going on here? Maybe my original assessment was wrong. And so I think that it's not just how many cycles people have had, it's how many cycles they've seen. And I think that that's going to be really relevant for the cycle, because the past 2 cycles were big enough to be pretty public and well known, and all over CNBC. And so when we have a third cycle, a third higher high within these past kind of this quote unquote big era of Bitcoin, I think that's really relevant for price, and I think that's how you can get some of these nonlinear events, because there's only so many times you can see the cycle keep going up and realize that some of your prior concerns about it being a bubble or dismissing it were incorrect.
Absolutely. Well, Lyn, Preston, it's been an absolute honor. Thank you guys so much for joining us today. I want to give a shout out to Lyn's book, Broken Money: Why Our Financial System is Failing Us and How We Can Make It Better. You can there's a link in the video description. And also, of course, Preston Pysh's podcast. Check out his latest episode, Binance, GBTC, FinCEN, and more, with Joe Carlosari. And of course, the one, the only, the legendary American Hodl. Guys, thank you so much, like I said, for joining me today on Simply Bitcoin IRL. I'm going to wrap it up real quick. Guys, we'll be back tomorrow. Simply Bitcoin live from the floor at Unconfiscatable. We'll also be doing interviews with Jimmy Song, Giacomo, Natalie Burnell, Mark Moss, James Lavish, and many, many more. Thank you guys so much for tuning in.